Most people grow up believing that money is a neutral tool, something solid and real that already exists before we use it. We are taught that banks lend out savings, governments manage currency responsibly, and our hard work is rewarded with stable value. This story feels comforting, logical, and safe. Unfortunately, it is also deeply misleading. The uncomfortable truth is simple. In the modern financial system, money is debt. Nearly every unit of money you use today was created because someone, somewhere, went into debt. When you take a loan from a bank, the bank does not hand you existing money taken from another customer's savings account. Instead, the bank creates new money at the moment the loan is issued. With a few keystrokes, your loan balance appears in your account. At the same time, a matching debt appears on the bank's books. New money enters the economy because new debt has been created. Repay the loan, and that money disappears. This is how most money is born and how it dies. This system is known as credit-based money creation. Commercial banks are the primary creators of money, not governments or central banks. Central banks create base money, but it is banks that multiply it through lending. Every mortgage, business loan, car loan, and credit card balance expands the money supply. This means that money and debt are inseparable. You cannot have one without the other. This reality leads to a powerful and often overlooked consequence. Because money exists as debt, the system requires continuous borrowing to survive. If borrowing slows down, money creation slows down. When debt stops growing, the economy contracts. Recessions are not mysterious accidents. They are moments when the expansion of debt falters. Growth, as we define it today, depends on more loans, more leverage, and more future promises. Interest makes this system even more demanding. When money is created as debt, only the principal is created, not the interest. Yet borrowers must repay both. To cover the interest, additional money must be created through even more debt. This creates a treadmill effect. Society must constantly expand borrowing just to stay in place. Falling behind means defaults, bankruptcies, and financial crises. For individuals, this system quietly shapes behavior. Saving money feels responsible, but widespread saving without borrowing actually shrinks the money supply. Meanwhile, borrowing is rewarded. Access to credit improves your lifestyle, boosts consumption, and is often framed as progress. Debt becomes normalized, even encouraged. Mortgages, student loans, and credit cards are sold as necessities rather than risks. We are rarely told that when everyone tries to be debt-free at the same time, the system breaks. Fewer loans mean less money circulating. Businesses earn less, workers lose jobs, and governments collect less tax. The system depends on people remaining in debt, even though personal freedom depends on escaping it. This is a fundamental contradiction at the heart of modern finance. Inflation is another hidden feature of debt-based money. As new money is created through lending, purchasing power is diluted. Prices rise over time, not because goods are becoming inherently more valuable, but because money itself is losing value. Inflation quietly transfers wealth from savers to borrowers and asset owners. Cash loses power, while debts become easier to repay in cheaper money. Those who understand this structure play a different game. Wealthy individuals and institutions focus on controlling assets, not hoarding cash. They use debt strategically, knowing that inflation and money creation work in their favor. Meanwhile, wage earners who save in cash fight an invisible current pushing them backward. The most dangerous part is not the system itself, but the lack of education around it. Schools teach us how to earn money, not how money is created. We learn to budget, but not to question the structure behind our currency. By the time most people realize money is debt, they are already deeply trapped inside it. Understanding this truth does not require anger or conspiracy thinking. It requires clarity. Money being debt is not a secret accident, it is a design choice. It has advantages such as flexibility and rapid growth, but it also carries serious risks. Recognizing how the system works is the first step towards navigating it intelligently. When you see money for what it truly is, your perspective changes. You stop measuring success only by income and start paying attention to assets, leverage, and resilience. You ask better questions about risk, stability, and freedom. Most importantly, you stop blaming yourself for struggles that are often systemic, not personal. Money is debt. It always has been in the modern era. Nobody told you because the system works best when people do not question it. Once you understand it, you cannot unsee it, and that awareness alone is a form of power. This understanding also explains why financial crises repeat throughout history. Periods of optimism encourage excessive lending, pushing asset prices higher and higher. Debt piles up faster than real income, and eventually the burden becomes unsustainable. When confidence breaks, lending freezes, money vanishes, and panic spreads. Then governments step in to restart lending through stimulus, bailouts, and lower interest rates. The cycle resumes, larger than before. Each rescue solves the short-term problem while increasing long-term dependence on debt. For ordinary people, this feels like instability and uncertainty, while for the system, it is routine maintenance. Knowing this pattern allows individuals to prepare rather than react. It encourages diversification, cautious use of leverage, and a focus on long-term adaptability instead of short-term comfort. Awareness doesn't magically eliminate risk, but ignorance guarantees vulnerability. In a world where money is created through debt, understanding debt is understanding money itself. That knowledge is not about rejecting the system, but about surviving and navigating it with open eyes, strategic thinking, and personal responsibility. Clarity replaces fear, intention replaces confusion, and informed choices gradually turn a hidden system into something you can consciously manage over your lifetime.